Well, so our topic of today is long in the sense that we want to cover two chapters, capital budgeting and uh, price transfer or you know. So capital budgeting, method of investment analysis. This is a topic which is more related to finance as compared to the managerial accounting. But we have to focus here that what methods we can use to evaluate the project, whether we have to invest in that project or not. So if you recall from your management finance courses that there are many ways that we use NPV, payback period, IRR, and these are the methods we use to analyze the project based on their cash flow, that whether this project is having a positive NPV or not. So that's the main idea we're going to cover in this chapter. So most of the things you already know from your finance courses, but here we're going to repeat it in a different way. So let's start capital budgeting method of investment analysis. What are the learning objectives of this chapter is apply the concept of a time value of money. As we know that we have to, when we have to compare the things, we have to compare in a way that present value with the present value and future value with the future value. So for any project, we have a future cash flows. So we have to convert those future cash flows into the present value to compare with the investment amount. So that's the reason that we use time value of money. So we have to discount the future values with the internally decided or the rate of investment the investor is looking for. With that rate, we have to discount it to compare it. So that's the main thing that we're going to talk about in this chapter. So evaluate discounted cash flow. So as I mentioned, we discounted the cash flow, future cash flows in order to make it as a present value, and non-discounted cash flows method to calculate rate of return, ROR. That's a rate of return. So this is again, this is the method in accounting or in finance we use in order to determine whether the project is successful or not, or whether we have to invest it or not. Analyze the impact of income taxes. As we know that the tax shield concept, we already discussed that, and in finance we discuss in much more detail, but here we are focusing only just income tax on discounted cash flows and capital budgeting decisions. Apply the concept of a relevance to discounted cash flow method of a capital budgeting. Assess the complexities in capital budgeting within interdependent set of value chain business functions. Apply the concept of defensive strategic investment to the capital budgeting process. Now, when we analyze from a managerial accounting point of view, the project, so there are two dimensions in the project. One dimension is we have to analyze the project by project way or a dimension, and projects are normally over a more than a period, one accounting period. So project, when we are comparing projects, so we are taking the whole life of the project, which can spread over many accounting periods. So that's one project spans multiple accounting periods. So this is how capital budgetings are decision made. So we have to look throughout the life of the project, not just focus on only one accounting period or the current period. We have to focus overall throughout the project life. Then the second dimension is we have to look at the current accounting period as well. Like in this particular year, what are the cash flows we are facing, what the cash outflows are there, what's the cash inflows, and then we have to do a capital budgeting regarding that. So one period contains multiple projects. So this is how income is typically calculated in accounting. But accountants, especially the financial accountants, their focus is only for a particular accounting period. And the finance people do the budgeting over the project life. So they are not confined to a certain particular accounting period. So we have to keep it in mind. And this diagram is illustrated this way in a very effective way. There are four different projects: Project M, Project N, Project O, and Project P. But these are covering different accounting periods. So, but if we want to look at the common accounting period for all the projects is a 2017, right? That's an accounting period. But the project is running from 2016 to 2020. So 4-year project. So we have to see from project dimension, it's a 4-year plan. But from the accounting perspective, we have to look at it in 2016 and then in 2017 independently. Now, why do we need a capital budget? Capital budget is making long run planning, like as mentioned, the whole life of the project, decisions for investing in project. So capital budget is a decision making and control tool that spans multiple accounting periods or multiple years. Now, 5 stages in capital budgeting. Why? If we divide the whole process of capital budgeting, we can divide it into 5 different stages. The first one is identify the project. So it's not that one fine morning a project comes to the mind of some senior managers or some CEO or CFO type of people in the corporation. It's a long process through which new projects are identified. So determine which type of capital investments are necessary to accomplish organizational objectives and strategies. Those projects which are in line with the strategies and the objectives of the organizations. So those are highlighted. And then we have to obtain information regarding that project. Gather information. Like if we want to install another factory, right? So what we have to do? So it means we realize from since long that this capacity is not enough to meet the demands of our customers. So what we have to do? We have to. So that's an idea comes, and then we identify the project. Okay, we want to install a new factory. Now this new factory can be where do we? So we have to gather the information that what we need to install a new factory. Where should it be? What type of licenses or requirements we have to fulfill to start a project, and all these information. How much capital we need? How much the capital we can arrange by ourselves, and how much we have to borrow. So these are all to gather the information. Now, after gathering information and identification, now there is a process which what we call it as a projection or prediction. Now, prediction is a very technical and it can be true or it cannot be. So it's possible. Forecast all potential cash flows attributable to the alternative projects. So if we have a 2-3 proposals of the project, so we have to see and expert people in that area is going to assess their cash flows. Then with these all proposals and their cash flows, then we have to present it towards a decision-making body like a board of directors or these types of bodies where they have to assess which project is good to take. Like so, decision stage. So determine which investment yield the greatest benefit and least cost to the organization. And the fifth one is that after that, if there is a decision that, okay, we want to take this project, then we have to implement and evaluate performances, obtain funding, tracking realized cash flows, compare results to project predictions, and then revise plans if necessary. So these are the 5 stages. The first 3 stages are theoretical one. They have to identify the project, then gather information, and then project forecast the cash flows, and then you have to present it for the decision making, and after decision then you have to execute or implement. Now, factors in investing decision, how the decision stage is going to be achieved. What factors the decision makers have to keep it in mind while deciding whether this project is good for them or not. So non-financial factors that affect the decision-making processes, effect of an investment on the market share. That if we start this, like for example, the idea of a new factory, that how is going to affect our market share? Is it possible that we can increase our market share? Revenue mix, that how much revenue we're going to generate from this project, productivity and yield, environmental sustainability. So these are all the non-financial issues. Where is the qualitative factors, effect of an investment on corporate governance, how we govern it. These are it's a qualitative, not quantitative way that we can measure it. Perceived corporate social responsibility. Now, for capital budgeting methods, there are four methods we normally talk in finance as well. And the first one and the most important one is the net present value, NPV. Now, NPV we have to calculate based on cash flows. And if NPV is positive, we consider those projects. With a negative NPV, we straight away or we can reject those projects with a negative NPV. Then there are three more methods, but these three more methods are methods of evaluating the capital budgeting is not independently operational until unless it is substantiated with the NPV. So NPV, we make a decision on NPV substantiated with the other like internal rate of return or payback period and accrual accounting rate of return or simply accounting rate of return, we can also say. Now, discounted cash flow, for calculating NPV, we need a discounted cash flow. So discounted cash flow, DCF method measures all expected future cash inflows and outflows of a project if they occurred at a single point in time. So the key feature of discounted method is the time value of money. So as I mentioned that if we are getting some cash flows in year fifth and right away we are investing, we cannot compare it like simple way, the amounts or the numbers. We have to discount this 5 year after 5 year, but we are getting with the factors of 5 year interest rate or a time value of 5 year so that we can make it like a comparison. So DCF method use the required rate of return, RRR, required rate of return. That's what the investor is looking for. So it's again, this is a rate which is in the mind of an investor that how much they are interested to get it, which is the minimum acceptable annual rate of return on an investment. So RRR is the return that an organization could expect to receive elsewhere for an investment of a comparable risk. So RR is also called the discount rate, hurdle rate, cost of capital, or opportunity. So there are different names for this rate, which we are using a very basic name, which is what we call it as a required rate of return, RRR, but there are many different names, right? I use the word discount as well, so we can also call it as a discount rate or a hurdle rate or a cost of capital or a opportunity cost of capital. So when we get this discounted cash flow, now we can calculate the NPV, so net present value. So NPV calculates the expected monetary gain or loss from a project by discounting all expected future cash inflows and outflows to the present point in time using the RRR. So what we need to calculate discounted cash flow, how we discount it with the RRR, like a required rate of return. And this discounted cash flow is going to give us like there is a cash outflow, there's a cash inflow. When we sum up what value we get, it is called as a NPV, net present value. So when discounted cash inflows equal or exceeds the discounted cash outflows, return on investment equals or exceeds the required rate of return. If it is positive, more than zero, then the returns on the investment is more than RRR. If it is negative, it means that the returns on investments are less than RRR. And if it is zero, then it means that the returns are exactly equal to RRR. So based on financial factors alone, only projects with a zero and positive NPV are acceptable. So as I already explained. Three steps for calculating NPV method: draw a sketch of the relevant cash flow and outflows, convert the inflows and outflows into present value figures using a table as a calculator, or sum the present value figure to determine the NPV. So as I mentioned, we calculate the present values of all the cash flows and then we compare it with the outflows with the inflows. Negative, positive or a zero NPV signal acceptance and negative NPV signals rejection. Now here is an example, and that's very interesting example. If you look at, I can show you. There's a project in which we are investing. We are supposed to invest, and there is an outflow of around 379,000 in outflow of $379,100. That is the investment. What is an outflow is that we can get it for $1,000, $100,000 every year for our next 5 years. The required rate of return is 8%. Now, without going into the discount, we can see that it's an investment is 379, 100, and the return is 500, which makes no sense because this 500 is over a 5-year period. So what we have to do, we here we already did, like the first one is a present value because we are investing right away in the current period. The next inflow is the year one. So we discounted with the 1-year factor of 8% rate. And then we discount the second, or we can divide it like this way as well without this table numbers. 100,000 divided by like 100,000 divided by 1 plus 0.08. The first year we're going to divide it with this plus $100,000 divided by 1 plus 0.08 square, and then so on for the 5 years. So when we discount it or we apply the present value with the RRR, we get it like there's a positive 20,000. Now, how is it positive 20,000? Because the discounted cash flow of 500 cash inflow of a 500,000 is 399 100 around this, and when we subtract the 700 379 100 outflow, so we get it as a positive NPV. So NPV at a new machine purchase is positive 200. Or you can these are the values we can get it from table, or this is the value we can altogether get it for an 8% discount. This is also for 8% discount. This value is also for 8% discount. We sum up all these 500 and then multiplied with this factor. So we get this value. This factor is we can also get it from the table. So this way we say that NPV is positive. Now, the second method, what we discussed in the beginning, like there are 4 methods. So the first one is NPV. The second one is IRR, internal rate of return. IRR calculates the discount rate at which the present value of expected cash inflow from a project equals the present value of the cash outflow. So what do you mean? That IRR is the rate at which the NPV is equal to zero, So basically we are trying to find out the required rate of return so that the cash flows NPV is equal to 0. So this method is possible to calculate where you do either you use an Excel or a calculator, or you can financial calculator, or you can do it by hit and trial method. Like you calculate it with the 8%, still there's a 20,000 positive. So we increase the rate of RRR from 8 to 8.5, and then you have to calculate it. So probably then you are able to get it 0 or close to 0, and then you have to rise it again. And if it has become negative, then you have to reduce it. So this way it's work. So analysts use a calculator or computer program to provide the IRR. Trial and error approach, use a discount rate and calculate the project NPV. Goal, find the discount rate for which the NPV is equal to 0. So that's what we are saying. And this again, this is the same example like what we discussed. And here we are trying to figure it out, the IRR. And at the 10% of discount rate, if when we apply the 10% discount rate, the NPV is equal to 0. So 10% discount rate is IRR, that makes the NPV is equal to 0. So if we compare the NPV and IRR, which method is good? And as in the beginning, I mentioned that NPV is the principal way of assessing the capital investment. The other three methods like RRR or payback period or the accrual accounting rate of return, these are all are substantiating what we get it in the NPV. If NPV is positive, we can calculate the IRR to support that. Okay, this is your RRR and this is IRR. So IRR is greater than your RRR. So this way you have to decide in favor of the project. NPV analysis is generally regarded as a preferred method. NPV express the computations in dollars, not in percentages. The NPV value can always be computed for a project. The NPV method can be used when the RRR varies over the life of the project. IRR can lead to a erroneous decision in a specific setting. So IRR is not going to be work everywhere. Now, sensitivity analysis useful to compare how the evaluation of the project will change if a change in the projected cash flow, timing of the cash flow, and required rate of return. So there is a so far we just discussed two methods. So don't confuse it in a way that this is our third method. This is not a third method. This is a method we introduce in the at this point to see that if there is a change in the cash flow, then what is going to happen to the NPV, and if there is a change in the rate of RRR, then what is going to happen to the IRR. So this is the way that we call it as a sensitivity analysis. Normally, banks do this sensitivity analysis while lending the money to the mortgage buyer or other borrowers. So sensitivity analysis useful to compare and evaluate. So here is a case like if the cash flows are reduced from $100,000 to $80,000, then with the rate of 8%, there is a negative NPV. And if the cash flow is 90,000, not 100,000, then the cash NPV is again negative. If it is 100, then it is zero. Then it's 20,000 with the 8%. I'm talking with the 8%, which we use in our example. So 20, and then if it is 110, then the NPV is 60,130. And if it we are getting, so these are the variation in our cash flows. And if there is a variation in IRR, then what is going to happen? We can see here that. So this is what we call it as a sensitivity analysis for our NPV and IRR. So we are calculating here. So this is our first part of this chapter. So I stop sharing and upload the another one.